All right, welcome everyone. Again, just wanted to give you a quick overview of my role and what I do at Eide Bailly. My title is Agribusiness Finance Specialist. We don't lend money. We don't have a charter. Of course, you're well aware of that. Basically, what my role is to help producers assemble their financial statements and, more importantly, help educate them on what the numbers are telling them and how they can use those statements to better manage their operation. And this will be my third renewal season in this role. Coming, it'll be 3 years next May that I've been here. And prior to that, if you take those 2.5 years, I've been in ag lending, coming up on 27 years. And pretty much all of that has been in the North Dakota region in the upper Midwest. So that's a little bit about my background. Some of this, a good chunk of this was talked about in the General Assembly. I think Jim talked on it, and so did Jeff. No secret out there, our 2020 cash flows have been heavily impacted by the government programs that we've seen. And we'll go through those, all of those ad hoc programs here in the next slide or two. But also along with the government programs, though, I will say that as we moved away from our second quarter pro forma balance sheets and started looking at mid-harvest and even up till right now, we've seen significant changes in performance, projected performance for 2020. And again, the run up in the current commodity prices, with maybe the exception of the livestock group, has turned a lot of operations from red to black. And I know you guys are probably updating balance sheets right now as well. We've been able to hold working capital, and some operations will definitely be profitable. I know in a lot of the areas in the eastern part of the state, harvest is wrapping up, if it's not in most areas, and the yields have been very good. I know the further west you go, you can run into some drier areas where there's maybe been a little bit more variability, but for the most part, between production, commodity prices, and the government programs, I think we're going to be pleased when we get to our year-end financial statements. Again, these are all of the government programs that in one way, shape, or form have impacted 2020 performance. The WIP Plus program, most of North Dakota started gaining eligibility for the 2019 production year, which basically the WIP Plus program is the shortfall in your multi-peril program. There's a $250,000 payment limit per eligible member of an entity or an operation. And then we also received the final 20% of the MFP 2.0 program that came out a year ago this past August. And then, of course, as we talked earlier, or the General Assembly did on the Paycheck Protection Program, primarily, boils down to labor, both from an owner standpoint and hired labor. Probably not as big in the ag sector as some other industries, but still a program that came into our working capital. And then, of course, there was CFAP 1.0 that came out right, I believe, in April or May or so, and that basically paid on current unpriced inventory on that first program. And again, that had a $250,000 payment limit as well. And one thing they did on CFAP 1.0 and 2.0 below, operating entities that prior were only eligible for one payment limit, they expanded that to 3 payment limits. So tremendous amount of support, I think, from the government on the ag sector, which was very much needed at that time. And you look at our trade impacts and just domestic demand due to the shutdown, really raised havoc. I would say more so on the livestock industry than the grain industry, but we definitely had impacts from ethanol as well. And then the EIDL program, I didn't promote this a whole lot in the ag sector. My concern with the program is the collateral complications that it can bring to you as a lender, and really, for that matter, the rates that this program brings to the table really isn't advantageous above and beyond what you as lenders could provide. I know there were some that were closed and put together, but I really wasn't a proponent of it. And then the size of the loans really were, in my mind, non-impactful to that operation and the interest savings that they could have. So, and then again, the ongoing CFAP program right now, that application deadline is December 11th. So I think North Dakota, visiting with the state FSA office, they feel they're fairly well down the road with the CFAP 2.0 program already. But one other thing I would mention, that the WIP Plus program for 18 and 19, we're about a week late here, but the deadline for those programs were actually last Friday. So if you have somebody that maybe didn't get their application in for 19, I would still recommend that they contact the local FSA office and visit, so they don't leave any dollars on the table there. But one thing I wanted to talk just a little briefly about, and I mean, this is no secret, you're all well aware what our projections and our balance sheets would look like without these government programs in 2021, and as well as when you look out into 2000 or in 2020, as well as when you look out into 2021, we strip those out of there. Even at these elevated commodity prices, what's our risk level? I've been doing a lot of 21 projections really for the last 90 days already, and they have changed a lot, obviously, with the commodity prices, but there's still risk out there. So I've talked about this. I think this is my third year of presenting at the banker seminar here. The need for more accrual analysis income statements out there. I still don't think there's enough of it being done, specifically on growing larger, more complex operations. There's the earn net worth piece of it is being done in software products like Moody's and that type of thing. And I think that tells us the outcome of the year. But if there's a need to dive into an operation and provide a more in-depth analysis of what's really going on, what changes need to be made for that operation to be successful, the accrual income statements is a really nice tool to help you provide that additional counsel. And not only that, I think on top of that, like I've said before, it helps, I think, you get in front of maybe some deteriorating credits a little bit quicker for workout programs and that type of thing. Just going to kind of move along here. No secrets here either. Financial analysis, what I'm seeing in the marketplace, working capital and cash flow are still king. I think that's, like I said, a no-brainer. We're doing a lot of sensitivity analysis around working capital burn rate. And once we burn through our working capital, we're also doing a core equity reserve analysis. I know Jeff talked about not relying on the collateral margins for repayment performance, but we need to still go through that math and understand what that number is. How much risk is there on that balance sheet, not only for the borrower, but for the lender as well. So, I like those two, specifically the working capital burn rate. I think it really is a nice tool to analyze your risk bearing ability and risk rating of those accounts. One of the other things I kind of see a little bit more maybe in the last year, some borrowers may be getting a little surprised that they're being asked to go out and locate a new lender, and really without any prior notification, or it just happens. So I guess just a quick comment on that. The plan Bs, are they communicated? If you're working with a credit that you think you might have to part ways with them, make sure that it's not only being communicated verbally at a minimum, of course, but also that there's some written documentation to follow that up so everybody's well aware of what's going on. Moving right along here, I'm going to talk a little bit about the producer of the future. I think, again, these are top of mind bullet points that are really no surprise. I think everybody has these types of producers in their portfolio. Obviously, strong management skills, accurate, timely financials. And I mean that, accurate and timely. As some of these operations continue to grow, they are going to have to possibly report their financials on a quarterly or maybe at a minimum semi-annual. And for those that need to do that, they need to mean something. So that's what I'm talking about, the accurate and timely. We want accurate financials so that not only you as the lender, but the borrowers can make management decisions off of them as well. And um, several of the operations that I work with, they really understand the value and really having an in-depth knowledge of what their numbers are telling them and how they can turn that knowledge into production management for the future success of their operation. Moving on down, continue to see technology advancements. We all know all the information that's in the cabs of these machines that these guys are running. How can we harness that information? Number one, to track our actual to budget. There's some really nice software tools out there. I think they're going to continue to evolve, but I think the producer of the future is going to have the ability to have that information in real time at his fingertips. And of course, I think this is a no-brainer as well. Break-even analysis. How do we have a marketing plan if we don't have a detailed enterprise break-even? Just wanted to touch on this a little bit, and I'm certainly not sitting here advocating that every producer needs to have a broker and a hedge line of credit. That's not what I'm talking about here. What I am talking about is I do see an increased number of producers that are moving that direction. And when I see that, some things to think about and maybe consider. If you know you have a producer, obviously, that is pulling margin calls from your operating line, can we set up a separate hedge line that just tracks the wiring of those proceeds back and forth so we can see what the interest cost per bushel of the hedges that we had throughout the year. And it just helps us with the accounting of the ins and outs to tie to year-end hedge statements. And of course, we want those lines to support a true hedging versus speculation. And then the next piece here, I really feel the producer of the future. I talked about the marketing piece of it. If we have producers and or lending staff that need education in that area, get hooked up with some trusted brokerage advisor firms that can help you with education. You think about the market period that we're in right now today and have experienced for the last 60 days, having the ability and the financial statement documentation where we can do 21 and maybe even 22 projections, we can have an impact on our profitability and performance for 2, possibly 3 production years. So again, I think marketing plan is critical for the future viability of these growing, more progressive operations. And the hedge lines of credit are, I think, one of the tools that is needed in a lot of cases. But again, maybe not for everybody, but both the lender and the producer need to understand how those products work. Going to wrap up here pretty quick. COVID and future impacts. I sit here, I've done 3 or 4 of these types of presentations in the last 3 weeks. And I mean, it's new to all of us, but one of the things I continue to try to get my arms wrapped around is how do I, as a consultant, continue to communicate with the producers that I have in the past. I think we're all dealing with that right now. I wonder what's coming in the next form of technology to help us get where we need to get. And again, I think this bullet point right here, how do we stay on the front line of communications with the emerging millennial producer, owner, manager? That age of operator and future owner is already ahead of, I think, some of the folks in this industry my age and possibly older, that they're used to doing a lot of their business relationships over their phone and not with a handshake and a personal visit. And I just think as an industry, ag is probably a little bit behind in that regard in adaptation of technology and communication styles. And I just think we're just going to have to be mindful of how do we position ourselves as lenders and consultants and all the business partners that belong to a progressive ag producer. How do we stay in front of them and maintain loyalty and keep that operation for generations? So uh, parting comment I'm going to make is we've already seen the marginal producers have left the business. We're in the middle of, and we're already have been experienced, the marginal managers are next. And in my travels, I see this already happening. So I just wanted to leave you with that thought. I don't know, Allie, is there any questions?
I do not see any questions, but if anyone does have any questions, please feel free to utilize the Q&A on the Zoom panel. Well, while we wait to see if anyone has any questions, I just wanted to thank all of our presenters today, and I wish everyone a wonderful week.